jobs report beats forecasts, adding 227,000 jobs in November. Welcome to Macro Matters, your regular look at what's driving the global economy. I'm Elena Casas. The US jobs market bounced back in November after October's surprise number of just 12,000, revised up to 36,000 today. That was distorted by two major hurricanes and the strike at Boeing. This month's number could add fuel to the argument that the US economy is strong enough that another rate cut now would be a mistake, although the unemployment rate was revised up slightly to 4.2%. The report is one of the most crucial pieces of data before the Fed's next policy decision on the 18th, when the market saw the chance of a cut at 75% before that jobs number. Well, for more, I'm joined now by Lauren Saidel-Baker of ITR Economics. Lauren, hi. What do you make of this number then?
This number is a good result, but we are still in a slowing environment as far as the labor market is concerned. We're seeing those signs of loosening, albeit from a historically tight starting point. So I think net, this is just another step in the right direction of somewhat loosening, but still a stable position for the U.S. Labor market.
It is slightly hotter than we expected, though, so does it complicate matters for the Fed?
Very slightly, but again, the Fed is never looking at just 1 month of data, especially a reciprocal month after, as you mentioned, that very weird October print. There's going to be a little bit more noise, a little bit more volatility. That's normal at this point in the business cycle. So the Fed is always taking a step back. They're looking at the big picture, the multi-month, quarter-long trend. They'll never focus on just 1 month. Again, I think they're still better than even odds of December rate cut, but what we're watching overall is not exactly when each cut will come, the exact path of interest rates. It's how many cuts in total will get this cycle.
And that would be my next question. Jerome Powell did say this week that he thinks the central bank now has space to be more cautious. So how slowly are you now expecting it to move next year?
Next year, I think, is a little bit more up in the air. The market has been pricing in several more cuts. However, we are starting to see some of the key indicators for future inflation returning, especially by that back half of 2025. I do expect somewhat resurgent inflation. Now, not resurgent to the recent peak levels that we saw back in 2021, 2022, but I expect inflation to be coming back into the conversation. We had seen some of the focus shifting away from the inflation numbers toward the loosening in the labor market. So as that conversation shifts back, we could see a hold in rates earlier into next year. And by the end of next year, I wouldn't be surprised if we even saw rate increases.
I have to ask then about the potential impact of the policies of the incoming administration, which thus far has been seen by equity markets as positive for corporate America. But what about the job market? What about the impact of potential tariffs, for example?
Absolutely. So the stock market, a lot of corporations are excited by the prospect of lessened regulation. However, many of the Trump team's other proposals, things like tariffs, things like mass deportations, those would tend to skew inflationary. Tariffs, because we're just adding costs, right, to foreign imports, and deportations would really be hitting certain segments of the labor market, especially areas like construction. I've seen one estimate that said as many as 1 in 4 construction laborers in this country are undocumented. So mass deportations of those individuals would really cut down on labor supply. Construction, more than almost any other industry, has seen tightness. They do not have enough willing workers, especially skilled workers. So taking those folks out of the country, that would really cause a hindrance for the construction market. And at the end of the day, that would cause higher wage inflation, especially in areas like construction.
The Treasury market, Lauren, has calmed in recent days. The yield curve has been flattening and yields on the 10-year were down on the back of the jobs number. What's the bond market telling us about what investors see in the year ahead?
Sure. The bond market is still expressing caution. Again, there are signals that we can pick up from things like the uninversion of that yield curve. really based on what is driving that. Is it the cooling in the economy that we're worried about for that 10-year reacting as it did? That could be a bit more of a cautionary tale. I think overall, though, most market observers are seeing a very strong US consumer that's going to support GDP overall, signals for our industrial and manufacturing economy bouncing back. So I think there is overall more optimism than not for 2025.
Lauren Saidel-Baker of ITR Economics, thank you so much for joining us. Well, that's Macro Matters. Don't forget, you can watch more videos on Reuters.com.